So why do companies issue stock? And we are going to focus in on the business entrepreneurial perspective of the stock market. So let's jump right into it. If you were to ever start a business, or you had a business startup that you wanted to get off the ground, you can structure your business as a sole proprietorship. You can structure it as a corporation. You can structure it as a LLC or limited liability company. And there are some variations of these business structures that I mentioned above. And there are other type of business structures out there, such as like a partnership, as opposed to a sole proprietorship. For our purposes, we're just going to focus in on the corporation because a corporation is the business structure that issues stock. And it doesn't really matter what type of business that you start or how you structure it. It doesn't matter what type of structure that you organize your business under. Without capital, without cash, without funds, your business will not survive. And this is one of the major reasons why small businesses don't survive is because they are underfunded. They don't have enough capital to support their business operations. So they have to shut down and go out of business basically. So with that said, how can you finance your business startup? How can you raise money to finance your business? Well, you could use your personal savings, which a lot of entrepreneurs do. A lot of people who are starting businesses, they go into their personal savings, their 401k, to start their business. You can get a loan from your family or friends, which a lot of people do. You can get a loan from the bank. You could find an angel investor. You may have a rich uncle or a friend who knows somebody who's well off that may have discretionary income that they could give to you to start your business. Or you can issue stock. And I know that I'm making issuing stock seem like it's so easy. Of course, there are extra steps that you would have to go through to issue stock for your company. But let's just keep it simple for right now, and we will go into the process of issuing stock later on. But for right now, issuing stock is a way that you can raise money for your business. There are advantages and disadvantages of issuing stock. And one of the major advantages of issuing stock is that the operation will be financed. And it usually is financed in a big way, your company making it. Um, the second advantage of issuing stock is that the company's founders will not be personally liable for any legal claims or misfortunes that take place operating the business. And this is basically a byproduct of setting up your business as a corporation. A corporation is considered a separate entity to the people who founded the company. So let's say that you started a business and you set it up as a corporation, and your business developed a product that caused people to get cancer, and then the next thing you know, there's a class action suit that's brought up against your company. Well, that class action suit only applies to the company, to the corporation. It does not apply to you. So if the judge says, hey, your company is responsible for these guys getting sick, so we are going to make a punitive and civil judgment saying that you are to pay these people $14 million. Well, that $14 million is not going to come out of your personal bank account. That's going to come out of the company's personal bank account. So, like I said, that is basically a byproduct of the way that you structure your business. That's why a lot of advisors and business consultants tell people who are starting a business to set their business up as a LLC or a corporation to protect themselves or shield themselves from personal liability for what the company does. And that's just a tidbit for you entrepreneurs out there or people who are interested in starting a business. Disadvantage of companies issuing stock. Well, once you incorporate your business and your stock is publicly traded, your business will have to disclose all financial and business operating statements. If you're running a sole proprietorship or a partnership and you're making millions and millions of dollars, that's your business. You really don't have to disclose that information to the public. But once you are publicly traded on the stock exchange and you have millions of investors investing in stock that represents your company, you will have to disclose your financial and business operating statements. And this is a requirement from the Securities Exchange Commission. And this is to protect people who are investing in stock. So publicly traded companies have to disclose all financial and business operating statements. The second thing is that you give up full control or ownership interests in the startup business. Um, once once you start issuing stock and you have other people that get involved in the business, then you give up full control. And since you give up that full control, you can be terminated from the very business that you started. There was a situation that occurred with Apple Computer. There was one at one point in time, Steve Jobs, who is currently the CEO, chairman of Apple, he founded Apple, and at one point in time, the board of directors at Apple voted for him to leave the company. So he wasn't even part of Apple for a period of time. Of course, he's there now. And finally, major business decisions will have to be approved by shareholders.